Despite market volatility in recent weeks, home builders have held steady, with several of the largest names staying in positive territory. However, these companies are still at the whim of several factors, especially interest rates that heavily affect new and existing home sales. With just a few minutes left till the closing bell on Wall Street, we're looking at how to navigate home builder stocks with the Yahoo Finance playbook. Joining us now is John Lovallo, UBS US Homebuilders Building Products Equity Research Analyst. John, it's good to see you here. So we've come out of the earnings for many of these companies. I thought one of the interesting trends that we saw is that even though, for example, some of the profitability metrics improved, many of them missed a little bit on orders. Talk to me about some of the cross currents here affecting the home building industry.
Sure. Thanks for having me on, Julia. And I appreciate the question. Yeah, it was an interesting quarter, and I think it was a very telling quarter in the sense that the home builders, which have been very focused on driving volume, and look, they're production builders. That's what they do. That's part of sort of the game here. But they showed some restraint this quarter with the interest rate volatility, and what they did is they, instead of pushing forward with incremental incentives, they kind of stayed back a bit, kept pricing very consistent, and were able to drive margins higher. And so I think it's that pace versus price type formula that builders are always trying to optimize. And I felt like they did a very good job this quarter in doing so.
Talking about the issue of affordability, John, how you're thinking about here with the 30-year fixed at 6.46.
Yeah, Josh, it's a great question. Look, I think where the public builders have really excelled is in their ability to attack this affordability problem by offering things like mortgage rate buydowns. So if you're buying a home from a public home builder, you're not paying, the 6.5% that's out there right now as a headline rate. You're paying probably between 5% and 6%, and in some cases even lower. And that is a tool that these folks have in their toolbox that the existing home market cannot compete with, and frankly, the smaller private builders can't compete with either. The size and scale and captive finance arms attributable to these public builders is a real advantage.
And John, what is that tool, though? What does it mean for the margins of these companies?
That's a great question. It is certainly an impact margin. Rough rule of thumb, I would say every sort of 100 basis points of buy down is about 300 basis points of margin. Now, that's already contemplated into the outlooks of these companies. And in fact, I would tell you that I think that there's likely upside to margins here as rates have pulled down a bit. It's less expensive to buy down when you're not buying down quite as far. And so I think that there's actually positive movement in margins if rates kind of stay where they are today or in fact go even lower.
So, John, put it all together with us for us with specific names here, who you think is sort of best navigating this environment.
Sure. I mean, we still believe that the entry-level first-time buyer is most active and will remain most active in the market. With that in mind, D.R. Horton is our top pick. They are the largest builder by volume by a margin of called 15%. They go to market with the lowest average selling price. They have the size and scale advantages that I spoke about, which helps with materials, with procurement of labor, things of that nature, which are very important in an effective and efficient build model. So that's the one that I would say is our top pick. We're pretty bullish across the group, though, to be perfectly honest with you, Julia. I do believe, though, that sort of entry-level first time is where you want to be positioned most optimally.